Tomorrow marks a week since the US and Israel launched widespread strikes across Iran, triggering a retaliation which has cast the region into a wider conflict, with fears it could spread further. More than 10 countries have been hit by drones and missiles as part of Iran's retaliation, including Saudi Arabia, Qatar and the UAE, leading to airspace closures and travel chaos, which has left thousands stranded and damaged civilian plus military infrastructure. Diplomatic compounds have also been hit, with drones striking the US Embassy in Saudi Arabia and near Washington's consulate in Dubai, sparking fires, but no reported injuries. Amid concerns around supply and disruption and the Strait of Hormuz especially, the strikes on energy infrastructure have sharply been in focus. Saudi Aramco's largest oil refinery, Ras Tanura, has been hit twice. CNBC has confirmed, with a fire also breaking out at the Fujairah oil facility in the UAE. And there are risks the conflict will widen, with the US firing a torpedo which sank an Iranian warship in the Indian Ocean, and NATO air defences shooting down projectiles heading towards Turkish airspace. The US President Donald Trump talked of a 4 to 5 week timeline for the conflict, but suggested it could go on for longer, vowing Washington's objectives would be met. Those objectives and justifications for the conflict remain fluid. European natural gas prices have also surged in the wake of the conflict. Qatar, one of the world's largest providers of LNG, halted production on Monday due to Iranian attacks on 2 of its key facilities. Quick look at those natural gas prices, and for the week, we've seen some extreme moves across all the benchmarks, from RBOB to the US to the UK and European measures. For instance, the UK measure up 61% over that period. Crude prices have surged in the wake of the Iran war, with supply disruption fears, especially around the Straits of Hormuz. WTI and Brent are tracking to post their best weekly performances since early 2022, which of course was when the conflict in Ukraine started. Now, as this conflict enters its 7th day, Mr. Trump has claimed the widespread destruction of Iranian military assets, also suggesting Tehran wants to make a deal, contrary to comments by Iran's top diplomat.
We're destroying more of Iran's missiles and drone capability every single hour, knocking them out like nobody thought was possible. As soon as they set off a missile, within 4 minutes, the launcher gets hit. They don't know what's happening. But we have the greatest military anywhere in the world. Their Navy is gone. 24 ships in 3 days. That's a lot of ships. Their anti-aircraft weapons are gone. So they have no air force. They have no air defense. All of their airplanes are gone. Their communications are gone. Missiles are gone. Launches are gone. About 60% and 64% respectively. Other than that, they're doing quite well. I said, what's left? But they're tough, and they want to fight. And they're calling, they're saying, how do we make a deal? I said, you're being a little bit late, and we want to fight now more than they do.
In some cases on markets, I think there's been a lot of angst, a big round trip pendulum swinging, where you've seen very aggressive selling and then a snapback. So a lot of Kospi, a lot of energy expended to go not
probably
not
the hardest thing in the world
week
to trade this week is the Kospi.
Right.
So you've had a 22% round trip. You might have forgiven yourself. I'll buy a bit of premium. I'll buy a bit of volatility on the Kospi. And then what does it do today? Nothing. It's unchanged. It's the hardest trade in the business, I reckon.
Underlying this has been what's been taking place with the institutional sellers versus the retail buyers. And on day one, early on the crisis, you had a lot of institutions selling, but some of the retail investors were trying to buy the dip. By the second day of the crisis, it seemed like it was the wrong trade for some of those retail investors. So they're instantly out there trying to sell into that 12% fall that we had. So I think what you're seeing, the retail investor, if they think this is a buying opportunity, has been smashed in some quarters of the market. When it comes to Europe, we're down heavily still. So we have expended a lot of energy, and we are weathering some of those wounds. The reflection that you've got is on the FX market too, where that is no longer reflecting a yield story. Even though we're talking about inflation this morning, what central banks could be doing, it is simply reflecting the energy price. So that FX story is fascinating to think how it's just been detached from the yield story, purely just related to energy now.
Yeah, all of the above. Look, as I said earlier in the week, we're trading on incomplete information. We don't know whether this ends tomorrow, or whether it ends in 5 weeks, or whether, as Trump potentially said there, this goes on a lot longer as well. We don't know if the Iranians want a deal, if the Americans want a deal, who doesn't. It's just so much smoke and mirrors in this as well. One thing to add to everything you've just said is that the safe havens are questionable at the moment as well. And you look at the gold performance week to date, which was supposed to be the safe haven of safe havens, and it's down 3.2%. And as a lot of experts in this area have said to me, they said, well, the trouble is we've come so far so quickly. We've had this enormous historic rise in some of these safe havens, especially gold. And now it's like, well, actually, is it acting as a safe haven? And the Swissy, when the Swiss central bank is talking about potential intervention now as well, again, is it a safe haven as well? So people don't know where to park their money at the moment as well.
Is it like the surf, where you have that huge wave that everybody can see, and then you have the rip, the undercurrent that nobody can see? And we know the wave has been gold this year. But if you look at the rip, the undercurrent here has been that investors have been getting back into technology this week. Despite all that's happened, one risky area of the market has actually been picking up some of the trade. The NASDAQ is up about 1/3% this week. The FANG Plus stocks are up to the tune of, 2.4% in the trading week. So again, that subtle movement into a risky area of the market, even with all this going on.
I think that's a bold trade. And the only reason I'll say that's a bold trade, and look, that's right, I saw that myself, and I was quite amazed that it's up 0.36 of a week. If the cost of financing remains higher for longer because of the inflationary impact, which is why, as you say, that the European stocks are disproportionately down, we're worried about our energy picture. But if that means that global interest rates remain higher for longer because all kinds of costs have gone up, from insurance to logistics to getting your goods to those key ports in LA or whatever it may well be, then that's going to have a big effect on some of those technology companies, not necessarily the Magnificent Seven, but some of those technology companies who are raising money, who have got questionable routes to cash flow positive as well. So whilst it's irrefutable that is the trade that's going on, I wonder how safe that would be over the medium term.
But again, the nuance. So it's the chips that have been under pressure. So is that because there is a view that, look, the AI adoption story might get slowed down to an extent given the dynamics we're watching? But the software stocks have picked up some of that recovery trade. So again, is the moat bigger because of the slightly delayed disruption?
I love the way investors are down on the third derivative to try and justify buying some of this stuff.